following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back once again to Volatility Views. This is, of course, your weekly look into the world of volatility and volatility trading. My name is Mark Longo from the OptionsInsider.com as well as the Options Insider Radio Network. And before we get going, I just want to remind our listeners, if you're interested in volatility, you're probably also interested in some other aspects of volatility and how that can be implemented in the marketplace, including what we talk about quite a bit on the Options Insider and on some of our other programs on this network, unusual options activity. And if that hits home with you, then you should join us on March 27th at the Chicago Board Options Exchange for our inaugural, our premier event from the Options Insider, our unusual activity forum. You can find out more about that, including all the great guests we have lined up, all the great panels and topics, and all the fun stuff you'll get if you register for that event. But hurry up, space is quite limited, and we mean that quite sincerely. So surf on over to theoptionsinsider.com/events to learn more. And now, joining me on the Volatility Views panel once again, starting off with the man beaming in all the way from the East Coast, a sunny East Coast this time for a change. He is none other than Don Schlesinger, the major domo over there at the Volatility Exchange. Don, welcome back to the show, sir.
Thank you. Yep, we have no snow to report in the forecast, so this makes this an unusual day.
We should add a weekly snow futures update to this show as well. I know it used to be big when I was down on the floor trading the snow over at the CME. Maybe we can add that to the show as well.
Weather futures, volatility of weather futures. I'll have to look into that.
Exactly. And also joining us on the show today, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, welcome back to the program, sir.
Hey, Mark. How's it going? I'm getting all excited for my unusual options activity seminar. I can't wait to learn all kinds of things about order flow and trading and everything that goes along with it.
It's going to be pretty hardcore. I'm looking forward to it. We're going to dive deep into the world of unusual activity, and of course, Mr. Sebastian will be there, listeners. So if you want to hear more from him, as well as a number of other great guests, then indeed, surf on over to theoptionsinsider.com/events. And speaking of surfing on over, it's time for us to surf on over into our volatility review segment.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review, and this is, of course, the portion of the show where we look back on the week's worth of action from a volatility perspective. And given the week we had, I think there really wasn't much to discuss, so I think we can just table the Vol Review for this week. What do you guys think? And go right into the mailbag. Nothing to hit on, right?
Nothing.
Right, nothing at all.
Who wants to go first? Who's the most excited?
I'll let Don go first.
All right, Don, I can hear you champing at the bit over there. Of course, I was joking. We did have quite the roller coaster week from a realized and implied vol perspective for a change. That was a little bit of a switcheroo there. We're always talking about implied vol going to the moon, but realized vol doesn't always keep pace. We actually saw a little bit of it for this week anyway, which is somewhat interesting. Also to the downside, which is a change. We've seen a lot of realized vol to the upside of late, not as much to the downside. So it was an interesting switcheroo in a lot of circumstances this week. But Don, what in particular, out of all the many things we saw this week, what in particular caught your eye over there in NASDAQ vol land?
Well, we actually had upticks, as you mentioned, in realized volatility in in all of the major stock indices, actually more so in S&P than in NASDAQ, but NASDAQ is now pushing the 14 handle for 1 month or 3 months, for that matter, realized volatility after having taken a dip down into some very uncharacteristic and very low territory. The S&P now is once again firmly entrenched in double digits after being in the single digit 7, 8, 9 range for quite a while. And we've got more normal conditions prevailing. I'm checking on VIX now, which looks at about 15 and a quarter or so, while the 1 month trailing realized volatility of the S&P is at 12.3. So just about a 3-point spread of implied, at least as measured by the cash VIX, over realized. And that's very much in keeping with the traditional volatility premium and spread of 3 to 4 or 5% that we've mentioned many times on the show.
Now, Mark, I know for a guy like you, a week like this is kind of like manna from heaven. It delivers so many fun things to discuss. So what caught your eye first in all of the back and forth this week?
I think the big interesting thing is to look at Monday and look at the way implied volatility far outperformed the overall market. We had a nice, sub 2% sell-off in the S&Ps. I think we sold off about 1.8%. And here we had the VIX up 5 points. I always, we had the VIX up 35%. No, we had the VIX up 5 points, 5%.
I was just going to say that just to get your gander up a little bit.
I know. And if you look at it, the VIX should, on a normal day, a normal 1.8% move, the VIX should not be rallying 5 points, all right, 5 percentage points. It should really be rallying maybe 2 or 3. So we had a big pop in implied volatility, and it looks like it was a couple of hedge funds that got caught way too short, and we're kind of in a position where they got squeezed out. It was, people know a lot about stock squeezes, but they don't know about volatility squeezes, and so half of Monday's move was a volatility squeeze.
It's funny. They must be listeners to this show, and they've been listening to us talk for ages about selling implied, buying realized. They decided, hey, let's do this on a massive scale, and then got caught short on the other side. So hopefully they're still listeners, and they're not too angry at us here on the show. But yeah, that's kind of interesting. We hear all the time about underlying squeezes and this random stock and equity getting a short squeeze to the upside. But VIX is becoming so prominent these days, and there's so much activity spread out across the board, and so many players playing in it in a variety of capacities, that we're starting to see these activities carry over into these products that used to be the realm of a select few. And it's kind of interesting to see these things playing out across the board. A vol squeeze. We talked about that on the floor quite a bit. This is probably the first time, you're right, that this is really spilling over to the broader public. We used to talk about S&P when I was trading SPX, upside and vol crashes to the upside all the time. That was kind of just a regular thing. You would have, this is the first time I think the broader public is seeing this playing out before them in a designated volatility product. And I know we have a listener question about that as well a little bit later, so I don't want to steal all your thunder about that. We'll talk about that a little bit later. But yeah, a great week from a volatility perspective and from a vol review perspective, at least from a looking back perspective. I was kind of tired, I'm sure you guys were too, of saying, well, we had a little bit of vol, but not much. There's not much to talk about going forward.
All I'm saying is the Pope left, and now everything's falling apart.
And we have spoken about this on many occasions, but yet again, I point out something that I've mentioned on the last couple of shows, and that is if you're going to trade volatility and you just consider it an asset, some kind of number that you're trading, you need to be concerned with the volatility of that instrument. So call it vol, if you will. And I am now looking at 1 month realized volatility of the S&P of 193.
Oh my gosh.
185 for NASDAQ. So if you are simply following the 21 data points of trailing historical volatility of these two major stock indices, and you plot them or throw them into an Excel spreadsheet, and you ask, what is the standard deviation of these movements, of this series of numbers? You are pressing 200% on each one of them.
You know, that kind of gets back to the listener question we had. I believe it was a show or two back where someone wrote in saying, why do we need to care about vol of vol? And that's a perfect example of why that could perhaps come back to bite you. That, and of course, the example we just had of those guys being caught in their short squeeze, getting bit by that vol of vol.
Is that vol of VIX or is that vol of realized vol on VIX?
Vol of realized vol, the actual market volatility.
It's madness, sir. What world are we living in?
That's crazy.
So yes, I forgot the name of that listener, but there you go. That's one of the reasons why vol of vol is an important topic and why we discuss it on the show quite a bit, because if you don't pay attention to it, it can come back to bite you in some relatively expensive ways. And speaking of listeners, it's time for that portion of the show that I know I like, and I think Mark and Don like as well, depending on the questions of the week. Of course, I'm talking about the mailbag.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to the old mailbag, a.k.a. the listener mail segment. We're lucky we get to squeeze another one in this week because I know I love doing this segment, and we have so many questions piling up from you guys. You guys are really, really taking the bull by the horns and shooting in some questions, so thank you for that. And without further ado, we'll kick things off with a question. I just love the handles of our listeners. A question from Big Ned. He writes, is possible, maybe I'll rewrite his question for us. He says, is it possible for an options trader to ever truly be flat, aside from closing his positions? I like this question, Big Ned. A little bit of a philosophical question to start us off here on the week. And of course, there's two answers to this. There's the absolute question, which is no. You can never can be completely flat. You're always going to have some gamma somewhere, some theta somewhere, something hanging around, a little bit of Vega floating around in a far off month. You learn this when you first get on the floor. You strive to be flat, but you're never really going to be flat. So you try to make yourself as effectively flat as possible if that's your goal. So you can focus on the one risk metric, the one Vega, whatever it is, time decay, whatever it is you're trying to focus on the most to profit from. That's kind of what you spend your time focusing on. So you can make yourself approximately flat, and then you can kind of go from there, scalping your gamma up and down. You look at your risk runs up and down 5%, 10%. You see how your position changes, and you adjust accordingly. So you can be approximately flat, but it's kind of the old glass half full, glass half empty question. Is that glass half full? I don't know. Same thing with flat. You can never really be truly flat, but from an effective standpoint, you can be effectively flat. Mark or Don, anything you want to add to our philosophical treatise here from Mr. Big Ned?
Well, what I would say is that you can be flat for a period of time, but as time passes and as you head toward expiration, your stuff will really, that can throw you out.
I think, as your partner was wont to say, you have to do stuff if you want to stay flat.
Right. That's the whole thing.
I'd also point out something else, that these days we have very sophisticated software. We have the ability to model effects of all of the Greeks, not only on 1 month, but across many. But in my day, when I was trading, if you had different expiration positions and you had something like a calendar spread, for example, and you took a look at your Vega and you had some sort of a ratio so that you thought that the long leg and whatever multiple in short or vice versa made your exposure to volatility fairly neutral. The problem with that mentality was that you were seeing a netting of what the machine was telling you was zero and kind of fooling yourself into thinking that you were flat and didn't have exposure to volatility, only to realize that when there's a shock to volatility, it doesn't come in equal magnitude across all time frames. And so instead of saying, well, if volatility moved 2%, this is what would happen, you realize that volatility might move 2% in the far month and 6% in the near month. And at least at the time, we didn't have really good ways to model that, because they always expressed your kappa or your Vega as, if volatility moves 1%, this is what's going to happen to your position. And if your number said 0, you thought, oh, well, I don't have any exposure to volatility. Wrong.
And all right, thank you for that question, Big Ned. A good philosophical, theoretical one to ponder as we kick off the old mailbag. Next up, we have a question from Alex Gumble. Interesting one. He says, how do market makers manage their volatility exposure when everyone else in the pit, or parentheses in the bin, because a lot of electronic trading bins out there now, has the same position? That seems like a difficult prospect. And that's a good question, Alex. That is indeed one of the key factors to successful market making. Everyone else around you is usually putting on the same thing. So how do you get in and out of it from a profitable perspective? I used to joke about that you'd once a big trade would go down, you would be a matter of minutes before you start seeing other guys in the pit start lowering bids and start doing other things to get out of it, and in the process usually squeeze out every last cent of profit that ever existed in that trade. It was usually a depressing process to see unfold, and you always usually knew where it would start. The guys who couldn't hold on to anything for more than a couple of minutes, those were the biggest culprits. I'll let you answer this in a second, Mark, because I know you'll probably have your own viewpoint, and Don as well. For me, it was interesting. I didn't encounter this as much in the S because the pit was so big, and there was such a diverse array of paper flow. It wasn't the case where we saw people doing the same thing over and over in perpetuity. I mean, you had some people doing regular customers, but there was a diverse array of paper flow. This became more of an issue, at least for me, when I started going out in some of the individual equities and starting to see how people held those underlyings, and how, particularly back in the late 90s, early 2000s, when a lot of big funds were driving a lot of these underlyings, the paper flow in some of them was just completely and totally one-sided. A good example was Intel, and I spent a lot of time out there, and that pit became notorious for the fact that there were really two trades out there. Paper would sell calls and buy puts in an enormous volume, and there was very little you could do as a market maker to get around that or get ahead of that unless you front ran the paper, essentially. And if you ended up owning net long calls or net short puts at any given day, you knew it was going to come back to bite you pretty quickly, because there were few ways to get around it. So that was a difficult dance, and it involved, like I said, actually sometimes aggressively getting short those ahead of paper whenever you could in order to weather that storm and then trade effectively with the other little paper that came in to make money on day trading. Or also would go out to other exchanges and try to sometimes lift their offers. This is pre-linkage, obviously, so it's easier to do today. And you could use that to mitigate some of your risk, actually turning some of the other locals and say, hey, let's get some of these out of here. And also spreading whenever possible. That wasn't really a viable option because everyone was doing the exact same thing. So you're racing for things in the book. But moral of the story, Alex, this is a difficult prospect, and one that we've seen a lot of market makers go away, because as paper flow becomes more one-sided, as spreads become tighter, this has become a more difficult prospect to overcome. And you need a lot of two-sided paper to overcome this, and if you don't get it, it's a difficult thing to do. Mr. Sebastian, why don't we start with you? What's your answer here for Senior Gumble?
I mean, I think it's you have to be smart about how much you're doing at various levels. You have to know what your levels are. And if you really like a trade and you think there's some edge in it, you can usually lock it in, trading another strike. So, I used to buy stuff and then find something else to dump off the Vega almost immediately. Unless the trade was a real berry, then I had no problem just sitting on it. But with these big orders, the key to success is recognizing where the bottom is. Does this guy have more behind it? And if the guy doesn't have more behind it, then yeah, you know what? Some of those quick guys will take out volatility. They'll start lowering it, and you'll go through a day where maybe you don't get your edge. But once those guys are out, the great thing is they'll actually overcorrect usually, and then the BDs will come in and start buying it. And so you have to understand that the only time you really get screwed when the whole pit has the same position is when you bought a really bad level. If you're smart about where you're buying, then you probably won't get screwed.
We should probably hit on that too. We've mentioned, I know you and I have mentioned levels, maybe Don before on the show. Something probably the retail public isn't that familiar with. That's typically how most of the professionals gauge their trading. They don't look at price so much, they look at levels where things are trading. It could be a vol level. I bought this for X percent vol. Typically, in some of these major products, it would be, here's your value, X percent undervalue. Sometimes you adjust, sometimes you don't. You keep that level in your head all day. Now I'm a buck under at $1 over, something like that.
Right.
But you have those levels in your head, and that kind of gives you a day-to-day or intraday gauge of where you actually put these trades on. And Mark's right. If you start off already at a half under, everyone else is a buck or a buck half under really bid, and you start picking those up, and then it moves down to a buck under, then a buck and a half under, you're going to be sweating versus the guy who already started off there and maybe started at a buck under. He's got a little bit more wiggle room than you do. So levels are certainly a key point. And, of course, that's another problem. I guess back to what I said before, as things are getting tighter, the nuance of levels is getting a little bit more difficult to find. Don, what say you to Mr. Gumble here?
Well, I agree with almost everything that was said, and so not a great deal to add. But it's very clear that as with anything, and Mark Sebastian said it. The point is don't get in at a bad price to begin with, and then try to make it come out right at the end, because that's really the critical level. Try to be intelligent. Try to be as smart as you can. You can't always be smarter than the next guy, but you can always try to be. And the idea is try to put on the majority of your trades at levels where you feel that you have some sort of an edge. And look, if that corrects itself so that the edge is gone, that sometimes is a good thing. It means that things have kind of gone your way, and the profit is there more quickly than having to sit around and wait for it. Now, obviously, if everybody tries to get out the door at the same time, you give back a little of that profit if you can't sit with it. But the other thing that Mark mentioned, and that I also agree with, is that sometimes you look to just kind of lay it off somewhere else. It's nice to look at something and say, I like this position, I've got an edge here, but if everybody's leaning the same way, you realize that taking it off may not be so simple. And so as a result, I would sometimes look at either within the same underlying, something that I could do, as Mark said, at a different strike, or sometimes even do intermarket kind of trades where I saw something that was correlated, another index that, behaved in a similar fashion. Let's face it, if you have a terrible day, the market crashes, you're not going to have one index going in a different direction. If you have a big spike in implied volatility, it's likely to be across all the major indices and not just your one. So you might fashion a trade that's somewhat opposite to the one that you have, but in another underlying to kind of hedge that way as well.
Now, Don, we should point out you had a little bit more of a luxury than Mark or I had, in that you were upstairs, so you were somewhat picking your poison and putting on what you liked, whereas we had to kind of just suck down whatever came our way. So it was a little bit more difficult for us to find some of those outlets, whereas guys like you could just cherry pick their way to profits all day long, correct?
And you're absolutely right, Mark. And I think that I probably would not have had the temperament or the wherewithal to be that kind of market maker on the floor. I actually tried it briefly when I was at Morgan Stanley and was out on the customer facilitation desk rather than on the proprietary trading desk. And I will say it publicly, it was the most miserable year of my 13 years at Morgan Stanley, because I sat there and I would say, who the hell wants this side of the trade? The phone would make it think, well, you got to take this down. And I'd say, but I don't want to do that. And they'd say, oh, but you have to do that. And I would say, oh, no, this is not for me. So you're absolutely right.
I can recall saying that to myself more than a few times. I can recall. It's kind of a shame. Mark and I, we've always joked about how if you go looking for education out there, you should go to someone who used to be a market maker, because they're pretty well versed in this stuff. But it's a shame that lifestyle is going away, or that method of career is going away, because and it's the same where retail can't really access that because there is no better way really to learn risk management than having it thrust upon you like that. And it's a shame that we can't approximate that somewhere in the retail world for people. It's not the same thing. It's kind of like the old immersion training for language. You kind of stick them in the country and they learn, they sink or swim. And it worked that way for market makers and for traders for a long time too. And it's too bad we can't approximate that in the retail world because I think it'll give a lot of people a much better handle on risk and risk management and how it really works. Don, you're going to like this next one, I think. Or should I say it will probably irritate you, so maybe I'll give you a crack at it first. Excuse me, this is from one of our European listeners. This is Mikhail coming out of the Ukraine. I think this is our first Ukrainian listener, at least that I've had right in. So top
Never
of the...
fails to amaze me. I have people halfway across the world listening to us.
The reach is broad, sir, broad and vast. Mikhail writes, why do I need to worry about Vega? I can see Don's hackles going up already. He says, I only sell strangles and iron condors. The risk is clearly defined. If the price is good, I sell. If the price is not good, I don't sell. So it's very simple. And Don, I'm sure I can hear you gnashing your teeth over there. There are many places to start with this and to correct some of Comrade Mikhail's misconceptions, shall we say. So what do you say to Mr. Mikhail?
Well, let's start with one thing. There's a difference between a strangle and an iron condor. And so a strangle, sometimes called a combination, depending on whether you sell out of the money or in the money options, but the risk profile is the same, is basically selling naked on both sides, normally out of the money puts and out of the money calls. And so the concept of saying that the risk is clearly defined is unfortunately not true when you don't top that off by buying further out strikes and then mitigating the potential for infinite loss. So when you're short and out of the money call and short and out of the money put, and the market moves violently in one direction, you really have unlimited risk. And because of the leverage factor of the prices of options and what we used to sometimes refer to as the galloping gamma that starts increasing at a square function, not square root, but square to the second power function, you have a great deal of risk. So that would be point number one. Point number two, if the price is good, I sell. If the price is not, I don't sell. That sounds like a perverted Don Schlesinger saying right there. Yeah, that's a pretty fine principle. If you can sell at a good level, do it, and if you can't, don't do it. I'm all for that. But that from that statement, one cannot imply that it's very simple and that you don't have to worry about Vega, because just because you get in on a trade at what you perceive to be a good level of implied volatility, as some of our listeners might have done a week ago, doesn't mean that that implied volatility isn't going to blow up in your face anyway, despite your best intentions. So if you think that the proper level for implied volatility is 15 and you sell something at 18 and you're very happy about that, don't say that Vega doesn't matter if next week it's at 25. So, what we say in our mind is a good trade, and what we still have to worry about because stuff happens is very different.
It always drives me crazy when people fixate just on price because there's so many issues with that. We see so many retail people saying, hey, I sold these puts for X price and it was fantastic, completely ignoring the fact that the underlying may have been $1 away the week before and the price was the same. And one trade was far better than the other. And from an implied vol and realized vol perspective, the positions have changed enormously. And yet, if you don't pay attention to vol and Vega, you completely ignorant of those types of things. And so that's why we tend to hit on that a lot on the show. I'm going to chalk it up to a translation here from Mr. Mikhail on strangles. I'm going to assume, hopefully he knows that he means that those are risk unlimited trade strangles, and maybe he meant to say something else. He is sounds like English is not his first language, but a good question nonetheless, Mr. Mikhail. A lot of points. We won't hit on all of them, but enough points. Don kind of did a good overview for us, but yes, for the love of God, Mr. Mikhail, please start paying attention to Vega. It's a clearly important issue for you. Next up, This one's for you, Mr. Sebastian. It's the question from Nix01. I love our handles out there. He says, I liked Mark's article, the VIX Activity, Hedge, or Sign. That was on the Options Insider back on February 27th. Can he potentially elaborate for us on the show about that article? So, Mr. Sebastian, why don't you tell our listeners who missed your article what you wrote about and kind of give us some of the key takeaways from that article?
Yeah, that's an interesting trade. One thing you've got to think about with VIX options is that in many ways the CBOE markets them as a replacement for owning puts, right? Wouldn't you agree, Mark?
Unfortunately, yes.
Yeah. So, we saw massive call buying on the day after we had that huge run up. So we had that massive run up, and then we saw a bunch of traders walk in and buy just an enormous amount of calls. And I believe Tuesday the 26th, it was an all-time record for VIX option activity, and call activity completely crushed it. And so, my question was, what is that a sign? And, I looked through a couple of years of data and kind of whether big, huge call spikes led to a dip in the VIX. And, the answer was mixed. More often than not, it did. But the times where it didn't, it really didn't. That's kind of an interesting, that was kind of one of my interesting things. But this was an especially unique event in that it was just massive amounts of call volume. So I decided to really pull up S&Ps. And if you pull up S&Ps, anytime we get a massive spike in put volume, all right, it may not be the absolute bottom of the market at that point, but it certainly signals the bottom of the kind of panic selling. And so as I look at kind of that type of volume, I was kind of asking myself, well, does that look like it is panic selling? And does that look like it's people buying, and that was the peak of panic selling in VIX or in SPX? And the answer ended up being yes, right? Because we were down on the day on the 26th and then rallied back to slightly up. And then we've been almost straight up since. So in this case, it did kind of point toward the fact that, volatility was relatively, overbought and the S&Ps were oversold. You can kind of catch this stuff on my blog. I expand on this stuff a lot on my blog every day, optionpit.com/blog. And but this was definitely something we thought was really unique.
Yeah, you can check out that article at Mark's blog, optionpit.com/blog. Of course, this listener found it on the Options Insider. You can find it there as well. An interesting article. I think this kind of gets back into what we talked about a lot of times on this show, the different indicators in the S&P itself versus the, let's say, tangentially related VIX these days, and which one is the primary driver, the primary indicator. I think it's an interesting takeaway from your article there that essentially, looking at VIX alone and the VIX call upside, it seems like the two outcomes that are probably most likely coming out of that are VIX kind of somewhat selling off a little bit gradually afterwards, or potentially a smaller probability, but a potential for a huge spike in a lot of the data you saw going afterwards. So it makes it a riskier proposition to come in and just follow suit and start selling some of that upside there.
Yeah, exactly. But that said, it looked that particular spike looked like such a crazy spike that it was pretty clear that something was wrong there. that things had gotten a little overbought.
A wee bit. The old vol squeeze. Maybe that's a title for this show. The vol squeeze or the VIX squeeze. I like it. Good synopsis there, Mr. Mark. Like I said, if you look for more of those articles from Mark on his blog or on the old Options Insider. When he's not doing shows like this, he's hunched over his keyboard cranking out articles for you, the dear reader. He has more time than I do these days to write these, so good, well done, sir. I don't know where you find the time. All right, good synopsis there, Mr. Mark. Next up, we have more of a a comment here from Mr. Rich at Pin Projects. Another, I love these handles. And he just says, commenting on our recent show, he says, Rule of 16, nice one. Thanks at options and pound volatility, or sorry, hashtag volatility. So he appreciated our discussing of the Rule of 16 on our last show. A relatively commonplace thing, but people like it sometimes when you revisit the old classics. He obviously found some use for that. So there you go. Good comment there. Good, well done, everyone here on the show from Mr. Rich. Next up, we have a question from Talos A. This is actually a timely one because it gets into what we were talking about at the top of the show with the unusual activity forum. He writes, insider trading has been making many headlines lately, and he's indeed right. Just check out our news feed at the Options Insider if you disagree. A lot of talk about Hines and other well-timed trades in the marketplace these days. He goes on to write, do you feel sudden spikes / drops in volatility on a strike are the best indicators of unusual activity / insider trading? A great question there, Talos A. If you listen to some of our other shows like the Option Block, we get quite a bit more into unusual activity on those shows, how we find them, what we're looking for in terms of key indicators. I'd say you're right. The volatility movements are part of that. I don't think they're usually the thing that first draws our eye, at least for us when we do our analysis. Usually it starts with a massive spike in volume, and then we kind of start drilling down from there because that's where you start learning. And then you start putting the pieces of the puzzle together, and one piece of that puzzle is indeed the change in volatility. You look at open interest to see what's going on. If this trade coincides exactly to open interest, probably closing. If it's not, you start digging even deeper. You start to look for what the true intent behind the trade is, and that can be a little bit clouded, a little bit muddy if the trade goes up predominantly mid-market. There's no clear indication of a buy or a sell, and you start using things like volatility as a gauge for the true intent of the customer. Did volatility drop markedly on that strike? Well, then you could probably infer that that was a sale of that contract. If it's an increase, then you can infer the opposite. And that's where tools like volatility come into play. They really help you try to decipher the true intent of the trade. You can also set up scanners for sharp spikes in volatility and things like that too. Of course, that can sometimes be triggered by other things that aren't related to unusual activity. So that isn't the most precise way to scan, at least in the first stage of filtration. I think volume is usually the easiest first stage of filtration, and then you dig down with other layers and other layers, and one of those subsequent layers is volatility. And you put all those pieces of the puzzle together, then you can usually somehow determine or decipher what the end user is up to and kind of piece it together from there. You look at things like underlying, a lot of other pieces to the puzzle that go into it, but volatility certainly being a key component of that. And if you'd like to learn more about that, let me just hit it again. TheOptionsInsider.com/events. Mark and myself and a bunch of other great guests, we're going to discuss all of this stuff in great detail. We're even going to throw in a tour of the CBOE, see the VIX floor, see the SPX floor, a bunch of other great stuff going on, a bunch of panels, a bunch of good stuff. March 27th at the CBOE, TheOptionsInsider.com/events. Get over there and register. We're keeping it limited to get a really good core group of people who really want to learn about this stuff. So check it out. Be there or be square, as they say. Mr. Don, Mr. Mark, anything you guys like to add for Mr. Talos A before we roll on?
No, I think we're good.
Yeah.
All right. Next up, we have a question from Nickel Silver. I'm guessing he's a commodity man. I'm just going off on a limb. Maybe metals. Who knows? He writes, Don, this is one for you. A timely one, another timely one. He says, where can I buy shares of Volex? Is it publicly traded? So there you go, Don, potential investor. What do you want to say to Mr. Nickel Silver?
I have to be really careful what we say on something like a radio show. So first things first, no, we're not publicly traded. Maybe one day that'll be something wonderful. But in the meantime, we obviously cannot make any kind of solicitation over the airwaves, and our investors have to be accredited investors. But thank you certainly for the inquiry. And what I would suggest is that you do go to our website, volex.us, and any one of the officers would be happy to speak to you. Give us a call or write to us, and we can further discuss the possibility if you would be interested.
And since he wrote in, technically he's soliciting you. So there you go. You're off the hook.
That's right. Correct.
All the lawyers can breathe a sigh of relief. So thank you for your question, Mr. Nickel Silver. All right. Thank you to everyone who wrote in on the mailbag, particularly all of you coming in from outside these here United States. It's always great to see the broad reach of the Vol Views show. I know this show has been really lighting it up of late. So it's great to see that you guys are writing in from hither and yon, because it certainly makes our day over here at the Vol Views show, and we love to hear what you guys are thinking. So if you'd like to join the rest of your listeners and participate on an upcoming show in the mailbag segment, then you could surf on over to theoptionsinsider.com, post a comment, use that comment system to shoot us a direct email. Of course, find us on Twitter, twitter.com/options, or you can find us on Facebook, or just go the direct route, send us a direct email, questions at theoptionsinsider.com. Be sure to put question for volatility views in the subject line. So there's no shortage of ways for you too to make your voice heard on the old mailbag. And now we're going to keep on rolling right into our final segment, the Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball. This is, of course, the portion of the show where we peer deep into the murky ether of the future and attempt to divine what the volatility gods hold in store for us for the coming week. And those vol gods have been, shall we say, a little bit cranky, a little bit ornery of late, so they're making this part of the show quite interesting, to say the least. And this is where I like being the host, because I get to go last. So by all means, Mr. Don, why don't you kick us off here and let us know what you think the vol gods hold in store for us?
Well, it's not only making us ornery, but it's probably making us wrong a little bit more frequently as well, which I guess could make us ornery. But there's just an awful lot going on. We have a new buzzword now, and that's sequestration, and that deadline is upon us. We still have things obviously going on in Europe. I've actually been following the euro of late and noted that after starting out at about the 130 level, we had an excursion all the way up to 136, and now all the way back down again to where we started, at least recently, back down to about 130 today. So some currency implications as well. So these are kind of unsettled times, and when you think that way, you usually think, well, that's the synonym, that's synonymous with volatility. So I hate to go out too far on a limb and say we're going to have some sort of continuing increase, but we are on an upswing. And while all these things are getting sorted out, I might feel a little bit uncomfortable predicting that we're going to turn around and be in the doldrums again. Things could be stirred up for a little while in the short term.
What about just from a realized perspective? I know that's very much your bailiwick. Do you think we can keep up on a realized vol level, or will that start to settle out? Probably a little bit easier way to go there.
Well, you know what? I invite listeners, and like all of us can do this together, but I would quantify it for listeners so that they have some sort of a feeling for what all of this actually means. Right now, short-term realized volatility is at about 12 or 13%. And when you calculate what that means on a daily basis, what it means is a movement of about 0.75% daily. So you take a look at an index like the S&P, which is now trading at around 1520, and you say, what's 0.75% on a daily basis? And that's an 11-point movement on the S&P. So for realized volatility to go up on any type of a meaningful basis, you've got to have day in and day out moves of more than 11 points on the S&P for this 12% volatility to increase. So I have to say, how do I feel about that? Do I see S&P moving more than 11 handles every day, day in and day out, in order to make that volatility go higher? On a similar basis, if people look at something a little bit more popular like the Dow Jones Industrial Average, well, there you're looking at approximately, I think it's like 86 or 87 points a day in and day out. And, I'd make the same type of inquiry. Do you think that that's reasonable? Actually, I recalculated. It's a little more. It's about 105 points. 105 points every single day on the Dow, day in and day out, all of a sudden that starts to seem like quite a bogey in order to keep things even at these levels. So when you get right down to it, that's what you're doing when you're predicting an increase in realized volatility, that on average, day in and day out, we could sustain moves of those levels. So I'm not sure how I would predict there, but I kind of ask listeners to join in. What do you think? But when you make a prediction about where realized or actual market volatility is going, that's the way you have to think about it to kind of frame your prediction.
And I often like to joke on this show, but it is very true that implied vol traders sometimes fail the basic math test. And Don, you just illuminated why very well for us here on the show. That old implied versus realized discrepancy tends to creep in quite a bit, and oftentimes realized can't live up to the hype.
Well, I will say just in conclusion that I always like to mention our friends over at the Volatility Institute, Robert Engel and his crew over at NYU Stern School of Business. They're providing us on our website with future, with forecasts of a realized volatility. Again, this is not VIX, this is not implied, this is not sentiment. This is their Garch modeling of where they would predict realized volatility is going to be for the next month, for the next 3 months, even for the next year. And they're in about the 14 handle for the S&P and the upper 16 for NASDAQ, even on a short-term level. So there's a prediction that realized volatility could, in fact, go a little bit higher, even over the short term, the coming month or 3 months, for example.
There you go. And what say you to add to this mix, Senor Sebastian?
I think Don sums it up perfectly. I'm not sure. I'm not sure that we're going to be able to justify much more than a 16, 17 VIX. The one thing is, I think if things really go to a head in Italy, we could see things further erode. But without a market breakout, that 19 VIX we saw on Monday might be the highest that we see for some time. I think a fair price for the VIX right here is probably 15 to 16.
Unless we see some more vol squeezes in the near future or another one of these crazy TVIX-like implosions of one of these ETPs that could send the VIX off moving in some crazy nonsensical direction.
Yeah.
Yeah, that probably was a ceiling, at least for the near term, unless this sequestration completely goes south and something unknown.
Oh, what a load of hooey this stat thing is.
That's always injects we talk about fundamentals, technicals, all these different things on this show. You have to add in the Washington factor into that mix, and that is completely unpredictable and usually nonsensical and kind of hard to model. So makes our prognostications a wee bit difficult this week. So with that said, we're going to wrap up our crystal ball segment. And unfortunately, that is all the time we have for this week's episode of Volatility Views. But before we go, I do like to check in with each of my cohorts here to see what they have cooking in their respective necks of the woods, starting off with you, Mr. Sebastian. What is coming up in the land we affectionately refer to here as the pit?
Well, we got a seminar coming up on March 13th, trading for Hedge. And then we've got on April 20th, I'm going to be teaching in New York. Maybe Don, you and I can get together and on the New York side for a cold glass of apple juice or white grape juice while I'm in town.
I'd love to do it because I am going to be away for a while, but I will be back by the 20th. So you'll let me know when you're in town, and I'd love to come down.
That'd be great. So yeah, but we're doing how to trade the VIX for thestreet.com, and in conjunction with our friends over at the Chicago Board Options Exchange.
Now, can they register for that at the Option Pit website?
Not yet. We're going to have the listing posted the next day or two.
All right, so by the time this show goes live on Monday, you should be able, listeners, to surf on over to optionpit.com and register for that and all the other fun events they have going on at optionpit.com. And speaking of fun things going on, Don, you just touched on some of the cool things going on at volex.us. Anything else cooking over there in Volex land?
Well, just one thing very quickly. Those people who consult our website on any type of a regular basis might have seen that we had a few articles, strategy articles, based on some research that we had done, and we needed to get pricing models for what would be real vol futures had they existed. Obviously, they're not trading yet. And so we modeled that, and we kind of found a small error in the methodology. So we took down some of those prices and some of the articles that were based on it while we were fixing it. So I'm happy to say that that data error has been fixed, and those original articles that we removed have now been corrected and reposted and restored. So for those of you who might be doing research on some volatility issues, or simply are interested in some of these articles that dealt with a real vol futures overlay on an equity portfolio, or spreading between VIX and realized volatility, you can jump back in with the assurance that these numbers are sound and are good ones now. And you can go to the drop-down menu under resources and then strategy articles. We have about 5 of them at the moment. If you haven't looked at or read any of those, you might find them interesting.
There you go, listeners. Lots cooking over there at volex.us and optionpit.com. And of course, as I mentioned at the top of the show, check out our Options Insider Premier event, our Unusual Activity Forum on March 27th. Mark will be there. I will be there. A number of other special guests will be there. A lot of great fun stuff going on, a lot of great panels, and a lot of great other stuff going on over there. Floor tour, all sorts of fun things. If you can join us here in Chicago, then surf on over to theoptionsinsider.com/events. And while you're there, check out our newest show, a newest addition to the Options Insider Radio Network. That's our Options News Rundown. Every day we take 5 to 10 minutes and run down the key headlines, the key stories making news in the world of options for that day, so you don't have to. Check it out at our website or in iTunes, Stitcher, or wherever else you find your podcasts. And on behalf of all of us here on the Volatility Views panel, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing, and of course writing in and making this show such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.